Hello and welcome. Your home is more than just a place to live. It's a powerful financial tool. As you pay down your mortgage, you build equity. This equity can help you achieve your financial goals. Refinancing can unlock this potential. It's like hitting the refresh button on your mortgage. Make your home work harder for you. Now you might be thinking, refinancing? Isn't that a complicated financial process? Well, it doesn't have to be. Refinancing is replacing your existing mortgage with a new one. You might get a better interest rate, lower payments, or even cash back. By understanding refinancing, you can save thousands or achieve other financial goals. Before we dive into the specifics of refinancing, it's crucial to grasp the concept of home equity fully. Remember that equity we talked about earlier? It's the portion of your home that you actually own, and it plays a pivotal role in refinancing. To put it simply, home equity is the difference between your home's current market value and the amount you still owe on your mortgage. For example, if your home is worth $300,000 and you owe $200,000 on your mortgage, you have $100,000 in equity. Now, this equity isn't just a number on a piece of paper, it's real money that you've worked hard to build up. And when you refinance your mortgage, you essentially have the opportunity to tap into this equity for various purposes, such as home improvements, debt consolidation, or even investing. Let's talk about timing. Refinancing at the right time is like catching a sale. Interest rates are key. Low rates mean mortgage discounts. Even small drops save you money. That's money back in your pocket. Home equity can also be a powerful tool. Use it for home improvements to increase your property's value. Remember, your home equity is a ticket to savings. Next up, let's talk about your credit score. It's like your financial report card. Lenders use your credit score to assess your creditworthiness. A higher score means better loan terms. A lower score might result in higher interest rates. So, check your credit score and report for errors. Improve it by paying bills on time and reducing debt. Refinancing isn't just about snagging a lower interest rate, it's about aligning with your overall financial goals. Think of your financial goals as your destination, and refinancing as a potential route to get there. Are you hoping to pay off high-interest credit card debt? A cash-out refinance could provide you with the funds to consolidate your debt and potentially save on interest payments. Dreaming of renovating your kitchen or adding that extra bedroom? Again, a cash-out refinance could be the answer. Or maybe you're looking to invest in your future by purchasing a rental property or contributing to your retirement savings. Accessing your home equity through refinancing could provide you with the capital to make those investments a reality. The key is to be clear about your financial goals and then determine whether refinancing can help you achieve them. Don't refinance just for the sake of it. Make sure it aligns with your overall financial plan. Just like surfing, timing is everything when it comes to refinancing. You don't want to paddle out when the waves are flat, and you certainly don't want to get caught in a rip current. Similarly, refinancing when market conditions are unfavorable can cost you money. Keep an eye on economic indicators that can influence interest rates, such as inflation, economic growth, and the Federal Reserve's monetary policy. When the economy is strong, interest rates tend to rise, while a weaker economy can lead to lower interest rates. Remember those interest rate charts we talked about earlier? Now's the time to put them to good use. Track interest rate trends over time to identify potential refinancing opportunities. You can find this information online through financial publications or by consulting with a mortgage professional. I know, waiting can be excruciating, especially when it comes to your finances. But trust me, when it comes to refinancing, patience can be your greatest ally. Don't rush into a refinance just because everyone else is doing it or because you're eager to save money. Take your time, do your research, and carefully consider all your options. Remember, refinancing is a significant financial decision, so it's essential to approach it with a level head and a well-thought-out plan. If interest rates are high or market conditions are uncertain, it might be wise to wait for a more opportune time. Sometimes the best course of action is to be patient and wait for the right moment to make your move. So, you've decided it's time to explore refinancing. That's great, but don't jump the gun just yet. Remember, knowledge is power, and when it comes to refinancing, shopping around is non-negotiable. Think of it like buying a car. You wouldn't walk into the first dealership and accept their offer without comparing prices and features, would you? The same principle applies to refinancing. Different lenders offer different interest rates, fees, and loan terms, so it's crucial to cast a wide net and explore all your options. Start by contacting your current lender and inquiring about their refinancing rates and terms. Then, reach out to at least 2 or 3 other lenders, including banks, credit unions, and online mortgage providers. This will give you a good benchmark for comparison and help you identify the most competitive offers. Remember, don't be afraid to shop around. The more lenders you contact, the better equipped you'll be to make an informed decision. When comparing refinance offers, it's tempting to focus solely on the interest rate. While a lower interest rate is certainly appealing, it's crucial to look beyond the surface and consider the bigger picture. Remember those pesky fees we discussed earlier? They can significantly impact the overall cost of your refinance. Closing costs are the fees and expenses you pay to finalize your refinance, and they can range from a few hundred to several $1,000s. These costs can include appraisal fees, title insurance, origination fees, and more. Be sure to inquire about these fees upfront and factor them into your comparison. Some lenders might offer a lower interest rate but charge higher closing costs, while others might have a slightly higher interest rate but lower fees. It's essential to calculate the total cost of each loan offer, including both the interest rate and closing costs, to determine which option is truly the most cost-effective. Here's a little secret. Refinancing is like a friendly game of chess, and negotiation is your secret weapon. Don't be afraid to negotiate with lenders to secure the best possible terms for your refinance. Remember, lenders want your business, and they're often willing to be flexible to win it. If you've received a lower interest rate offer from one lender, don't hesitate to use it as leverage when negotiating with other lenders. Similarly, if you have a strong credit score and a solid financial history, be sure to highlight those factors during negotiations. You can also negotiate on closing costs. Some fees, such as origination fees, are negotiable, so don't be afraid to ask for a reduction. The key is to be polite but firm in your negotiations. Remember, every little bit counts, and even a small reduction in interest rates or fees can save you money over the life of your loan. Navigating the world of refinancing can feel overwhelming, but remember, you don't have to go it alone. A qualified mortgage professional can be your trusted guide throughout the process, providing valuable insights, answering your questions, and helping you secure the best possible deal. Think of a mortgage professional as your refinancing Sherpa, guiding you through the intricacies of the process and ensuring you reach your financial summit. They can help you compare loan offers, understand the fine print, and negotiate with lenders on your behalf. Don't hesitate to seek out recommendations from friends, family, or your financial advisor. A knowledgeable and experienced mortgage professional can make all the difference in ensuring a smooth and successful refinancing experience. Now, let's dive into a specific type of refinancing that can be particularly powerful: cash-out refinancing. Imagine being able to tap into your home's equity and access a lump sum of cash for various financial needs. That's precisely what cash-out refinancing allows you to do. With a cash-out refinance, you replace your existing mortgage with a new one for a larger amount than you currently owe. The difference between the new loan amount and your existing mortgage balance is paid to you in cash. It's like unlocking a hidden treasure chest within your home's walls. This cash can be used for a variety of purposes, from home renovations and debt consolidation to funding your child's education or even investing in your future. However, like any financial tool, cash-out refinancing comes with its own set of pros and cons, which we'll explore in detail to help you make informed decisions. Let's start with the benefits of cash-out refinancing. Access a large sum of money at a low cost. Interest rates are typically lower than personal loans or credit cards. Use the cash for various financial goals. Renovate your kitchen or consolidate high-interest debt. The possibilities are endless. Home improvements can significantly increase your property's value. Imagine transforming your outdated kitchen into a modern culinary space, or adding an extra bathroom to enhance convenience. Debt consolidation is another smart strategy. By using your home equity, you can pay off high-interest credit card debt, resulting in lower monthly payments and less financial stress. Investing in opportunities is also a viable option. Whether it's starting a new business, investing in the stock market, or purchasing additional real estate, leveraging your home equity can provide the necessary capital. The possibilities are endless. With careful planning and the right strategy, you can use your home equity to achieve your financial dreams. Whether it's home improvements, debt consolidation, or investments, leveraging your home equity can fuel your financial goals and lead to a more secure future. Cash-out refinancing can be valuable, but approach it with caution. You're taking on more debt, even at a lower interest rate. The temptation to overborrow is a primary risk. Overborrowing can strain finances and risk your home. Home values can fluctuate, affecting your mortgage. Refinancing can also impact your credit score. Each application for refinancing results in a hard inquiry on your credit report, which can lower your score. If you miss payments or default on the new loan, your credit score can suffer even more, making it harder to secure future loans. Consider the long-term financial implications. While lower monthly payments might seem attractive, extending the loan term means you could end up paying more in interest over time. For example, if you refinance to a 30-year mortgage from a 15-year mortgage, your monthly payments might decrease, but you'll pay more in interest over the life of the loan. Additionally, if the housing market declines, your home value might drop, leaving you with a mortgage that's higher than your home's worth. Always consult with a financial advisor to understand the full scope of refinancing and ensure it aligns with your long-term financial goals. One of the most common uses for cash-out refinancing is debt consolidation, particularly for high-interest credit card debt. While this can be a smart financial move, it's essential to approach it strategically and avoid falling into a debt trap. Before you consolidate your debt, create a realistic budget and assess your spending habits. If you consolidate your debt without addressing the root cause of your overspending, you could easily find yourself back in debt, this time with even more debt secured by your home. Treat debt consolidation as an opportunity for a fresh start. Once you've paid off your high-interest debt, commit to living within your means, paying your bills on time, and building a solid financial foundation for the future. As we've seen, cash-out refinancing can be a powerful financial tool, offering numerous benefits, but also carrying potential risks. The key is to weigh these factors carefully and make a calculated decision that aligns with your individual financial situation and goals. If you're considering cash-out refinancing, take the time to thoroughly research your options, compare loan offers from multiple lenders, and seek guidance from a qualified mortgage professional. They can help you understand the intricacies of the process, assess your financial situation, and determine whether cash-out refinancing is the right move for you. Remember, your home is more than just a place to live. It's a valuable financial asset that can be leveraged to achieve your dreams. By approaching cash-out refinancing with knowledge, caution, and a well-defined plan, you can harness its power to create a more secure and prosperous financial future. We've talked about the potential savings of refinancing, but how do you know if it's truly worth it for you? That's where the break-even point comes in. It's like finding the sweet spot where your refinancing savings outweigh the costs. Think of it as a balancing act. On one side, you have the closing costs associated with refinancing, those pesky fees we discussed earlier. On the other side, you have the potential savings from a lower interest rate or other favorable loan terms. The break-even point is the point in time when those savings surpass the closing costs. For example, let's say your closing costs for refinancing are $3,000 and you're saving $100 per month on your mortgage payment. Your break-even point would be 30 months because that's how long it would take for your monthly savings to equal your upfront costs. After that, you're officially in the black, enjoying pure savings. Now let's talk about loan terms. When you refinance, you'll typically have the option to choose a new loan term, which is the length of time you'll have to repay the loan. One option is to go for a shorter loan term, like 15 years instead of the traditional 30. A shorter loan term means you'll be making higher monthly payments, but you'll pay off the loan faster. And here's the kicker. You'll save a significant amount of money on interest over the life of the loan. Why? Because you're paying down the principal balance more quickly, which means less time for interest to accrue. Think of it like running a sprint. It takes more effort up front, but you reach the finish line faster and with a greater sense of accomplishment. So if you're comfortable with a higher monthly payment and your goal is to become mortgage-free sooner, a shorter loan term could be the way to go. On the other hand, maybe you'd prefer to lower your monthly payments and free up some cash flow each month. In that case, a longer loan term might be a better fit. A 30-year mortgage is still the most common loan term, and it offers the benefit of lower monthly payments. This can be particularly appealing if you're on a tight budget or prefer to have more flexibility in your monthly expenses. A longer loan term can also make sense if you plan to stay in your home for an extended period because you're spreading out the payments over a more extended time frame. However, it's important to remember that a longer loan term means you'll pay more interest over the life of the loan. It's like taking a leisurely stroll instead of a sprint. You'll get there eventually, but it will take longer and cost you more in the long run. So, how do you decide which loan term is right for you? It all boils down to your individual financial situation, goals, and priorities. There's no one-size-fits-all answer. If your top priority is to save money on interest and become mortgage-free as soon as possible, a shorter loan term is generally the better choice. However, if you need to keep your monthly payments as low as possible or prefer to have more financial flexibility, a longer loan term might be a better fit. Remember, refinancing is a personal decision, and the right loan term for you will depend on your unique circumstances. Take the time to carefully consider your options, weigh the pros and cons, and choose a term that aligns with your overall financial goals. Now let's talk about a crucial aspect of refinancing that often gets overlooked: closing costs. These are the fees and expenses associated with obtaining your new mortgage, and they can range from a few hundred to several $1,000s, depending on your loan amount and lender fees. Think of closing costs as the price you pay for the privilege of refinancing. They can include appraisal fees, title insurance, loan origination fees, credit report fees, and more. While these costs might seem like an unwelcome surprise, they're a standard part of the refinancing process, and it's essential to factor them into your overall refinancing calculations. Remember that break-even point we discussed earlier? Closing costs directly impact how long it takes to recoup your refinancing expenses through monthly savings. The higher your closing costs, the longer it will take to reach that break-even point and start enjoying pure savings. Another critical decision you'll face when refinancing is choosing between a fixed-rate mortgage and an adjustable-rate mortgage, or ARM. It's like choosing between a predictable scenic route and a potentially more adventurous path with unexpected turns. With a fixed-rate mortgage, your interest rate remains the same for the entire life of the loan. This provides predictability and peace of mind, knowing that your monthly payments won't suddenly increase due to interest rate hikes. It's like cruising down a straight highway with no surprises along the way. On the other hand, an ARM typically starts with a lower interest rate than a fixed-rate mortgage, but the rate can adjust up or down over time based on market conditions. This can be appealing if you're looking for lower initial payments, but it also comes with the risk that your rate could increase in the future, potentially leading to higher monthly payments. Refinancing isn't one size fits all. Align it with your unique financial goals. Reduce monthly expenses or free up cash flow with a lower interest rate. Or pay off your mortgage faster with a shorter loan term. Your home is a powerful financial tool. Leverage it to achieve your dreams. Navigating the world of refinancing can feel like charting a course through unfamiliar waters. But remember, you don't have to embark on this journey alone. A qualified mortgage professional can be your trusted guide, providing expert insights, answering your questions, and helping you navigate the complexities of the refinancing process. Think of a mortgage professional as your refinancing compass, helping you steer clear of potential pitfalls and chart a course towards a successful refinancing experience. They can provide personalized advice based on your financial situation, help you compare loan offers from multiple lenders, and ensure you understand the terms and conditions before you commit. Don't hesitate to seek out recommendations from friends, family, or your financial advisor. A knowledgeable and experienced mortgage professional can make all the difference in ensuring a smooth and beneficial refinancing journey. Refinancing can be a powerful financial tool, offering the potential to save money, access equity, and achieve your financial goals. Your home is more than just a place to live. It's a valuable asset for a brighter future. Whether you're securing a lower interest rate, tapping into equity for renovations or debt consolidation, or adjusting loan terms, knowledge is key. Seek guidance from a trusted mortgage professional. They can provide personalized advice and help you navigate the process. Take the reins of your financial future and explore refinancing. With expert guidance and a clear vision, create a secure future for your loved ones.